nice flurry of people arriving in. Some faces are recognised, some new ones. So welcome to the finance.vote Discord. This is kind of where our work goes down for our DAO. We build governance infrastructure. So we're trying to do all the kind of DAO governance parts that organizations are going to do. We think there's going to be 1,000 DAOs a day at some point, and we want them all to use our tech. We want to make it super easy to spin DAOs up. And we've been talking to Alex for, it must be about 4 or 5 months now, Alex, right? Who's kind of come on as an advisor and has already given us a load of great advice, not just about the market and where things are moving, but he has a kind of incredible insight into everything that goes on in the market. And it's just, he gives us a great steer on our token economics and product market fit, and gives us a real critical feedback when we need it. So welcome, Alex.
Thank you very much, Nick. For those who don't know me, my name is Alex. I'm known in social media as as my little monkey there shows, Kruger Macro. I'm a crypto trader and an economist by training, and I have 20 years of experience in commodities and global macro trading. And I'm a Bitcoin class of 2013. An advisor to quite a few DeFi projects, and I'm also currently launching a fund with a few partners and a few other things. In fact, I haven't slept much since December 2020, to be honest, and I'm very happy about it. It's been an amazing ride, and I hope everyone is having an equally incredible time.
Yeah, there's no time to rest in a market like this. We're just burning ourselves out, making the best of everything. But yeah, these things are, I think, probably where we can get to actually first is, it's been about since, well, it was really from the Corona crash last year, wasn't it? When everything sort of turned around, that big shakeout in the market where it looked like it was completely all over. And then since then, we've bounced out of that big dip where I think Bitcoin went to about $3,000, and it has literally been up only mode outside of a few kind of blips for what must be like 18, 19 months now. Like how much can go on for?
You just broke up. Hello?
Oh, was everyone hearing me?
I couldn't hear what you just said.
Right.
After,
so I was sort of giving a kind of review of what happened over the last sort of 18 months. Like how much longer do you think this run can last for? We're just breaking all-time highs. What's the immediate?
This is the thing. I think the market has changed with the change of market participants in the marketplace. One thing that hasn't changed is, and I don't think it's going to change for a long time, is the fact that crypto and Bitcoin will continue having very large drawdowns. Not thinking 86% anymore, but this is crypto. This is not equities. It's very different for basically 3 key reasons. One is liquidity is highly fractioned, which is entirely different to what you see in traditional markets, where basically gold, the market, for example, for gold is split between the interbank market in Europe and basically managed by a few banks, and the CME spot market, which is about 20%. Same with most commodities, same with stocks. Crypto, we are all over the place. Liquidity is everywhere. There is 10 large exchanges and dozens of smaller ones. The other fact is the fact that people cannot get money fast enough to buy the dip. There's no easy access to liquidity beyond a certain point. So when we have big flashes, there's just not enough liquidity to basically avoid a big crash from happening. And I think that's going to take a couple of years more to get resolved. And the other thing is basically market makers are not regulated, and they're not forced to make a market As you may see, basically, for example, primary dealers in the bonds market, and you see this all across traditional finance, market makers have to make a market. In crypto, nobody has to make a market, and you can just basically take a step aside when you see bad flow coming in entirely.
So all of that was super
But
interesting. Yeah.
That was onto the point. I'm getting off the question there. The point was we should continue seeing very large corrections, and in fact, Bitcoin. This is one of the beauties of Bitcoin in a way for traders. We get a 10 to 15% correction every 4 to 6 weeks, like clockwork, and on alts we get 25 to 40% every time. But that being said, the change here in view is that in the market is that should not change the trend. So I do not expect prolonged bear markets any longer. For as long as the macro remains the way it is right now, basically with high amounts of excess liquidity floating around the system and central banks pushing liquidity in, which is the base case scenario. And I think that's where in this game for the long run. So
I completely agree with you on. I mean, I found the kind of insight on the market dynamics on the back end around market makers, liquidity, and flow. That is kind of a bit of it's behind the curtain, right? So that's very interesting. So what causes these rapid sell-offs? Do market makers literally take when you said when bad flow is coming? Could you elaborate on that?
Well, yeah, bad flow is basically when for example, say bad flow would be you have a large, very large trader who is hitting 10 desks at the same time, and he's offering basically he wants to do small size in each one. But if you know who you're trading with on the other side, you know that this guy is actually doing 10 times more or 20 times more, and you're gonna get run over if you take that order. So you as a market maker do not want to take that trade if you can.
So you can see a whale coming in, basically, who's got more market power than you, and
it's more than that. You know that this guy is actually fucking with you. And excuse my French. So it's not just one order he's gonna do with you, and he may say it's just one order, but it's actually way, way more. So take that, multiply by 100, and that's something that happens in the market. The other thing is just leverage. The thing is. The crypto market participants have very easy access to leverage, and they use it and they abuse it because they want to be long. Simply put, they just want to be longer than they are, and they can be. So we have this tendency of getting overly leveraged, and every now and then when you reach a point of basically where you get too close to the stops, you may get really, really bad flashes, which is basically just liquidations cascading, or in also not just simply stop runs, but like well, you all seen it, epic stop runs. Like we break 50, we go to 44. We break 40, we go to 30. That doesn't happen in other markets. It just simply doesn't happen.
Yeah. Is that because of the amount of excess sort of degen leverage in the system? And the kind
it's a combination of the leverage plus what I was talking about before, which is basically the nature of fraction liquidity, market makers, and inability to get all the liquidity one wants to basically make a market.
And I think the kind of I agree with you as well. I can't see there being another. So like sort of going through the last bear market. Everyone had give up on crypto. It was, I'm sure you were around on crypto Twitter, that it just got so quiet, and it seemed like development stopped and ICOs stopped happening, and new money coming into the space. Funds wanted equity, not tokens. Everyone would give up on tokens. I just can't see that happening again. So it's kind of like a technology adoption thing. I think the sort of genie is out of the bottle on crypto in that sense. So there's like a technology adoption wave, which are these like sigmoid curves that go up in waves as people adopt new technologies. You've seen it in TVs and radios and the internet. And that's going to happen in crypto. And it's just essentially keeps going up until, the majority, everyone who's going to use crypto in the world, which could be almost everyone, is going to use it. And that's going to continue. But you mentioned that the liquidity coming from the central banks is playing a big role. So is that literally the quantitative easing that's happening at the state level?
No, it's mostly interest rates at the zero bound. It's mostly interest rates.
Right.
Yeah, basically, liquidity injections are really important, but are secondary. And if you look at basically prior quantitative, prior taperings, they have not been such a big deal. Let me actually drill down on that. Is basically we had two very important occasions of tapering. One was 2013, and the other one was 2018. But they're different things. 2013 was the central bank tapering by reducing the amount of purchases they're doing till they got to zero.
Mm-hmm.
Which is what's going to be happening now, starting in highly likely in the first FOMC meeting of on the next one, which is early November, and they're going to be doing that quite likely until June 2022. Now, a much more bearish approach is basically doing quantitative tightening, or that's the word the market came up for this, which is taking that a step further and actually reducing the size of the balance sheet. That's one is reducing the liquidity you're injecting, which is what's going to be happening now. The other one is actually taking money out of the table.
How does
the
that
latter basically happened in 2018, started basically with Powell in September of 2018, basically hinting that it's going to be happening. And then the market, equity markets, at the time, crypto was highly decorrelated with equity markets. It's not the case anymore. But at the time, basically, equity markets starting a very, very sharp sell-off of that Powell speech in September, culminating with basically the Fed implementing the tapering in December, I think it was December 14th. By December 24th, it was all-out panic, and it only took is a very brief, intense panic for the Fed to turn around this decision. So for those who don't know, this is a beautiful study case. You can actually pull the charts out, and there's a lot of alpha in that occasion. In what happened then was first we had Trump come in on Christmas, literally saying "buy the fucking dip," and basically the market stopped its free fall, and then and changed the trend, and then. A few days later came basically Mnuchin and basically Powell turning around its decision. Basically Powell getting dovish again. But the lesson there, and sorry to digress so much and getting off crypto, but the lesson there is if you look at that Trump speech and that Christmas day of 2018, what you're gonna see is an incredibly sharp sell-off on Sunday in very low liquidity. This is an extreme case, but this is something that happens regularly. Markets selling off sharply on a Sunday open when the US opens futures markets and Asia is opening. There's very low liquidity. A very sharp drop there that reverses in full and makes a perfect B. The sharper and faster, the better. On a Sunday, that gives you an incredible reversal trade for the week ahead. And now that basically crypto becomes highly correlated with equities during big crashes, basically the correlation trends sharply higher when equities are correcting beyond a certain point. Therefore, you're going to be able to take advantage of these exact kind of setups in crypto. And it's not just a trading setup. This is even for longer-term traders or portfolio managers. This gives you an entry into a trend that can sustain itself for weeks or months. And weeks or months can be, in crypto, can be a few X in returns if doing the riskier things on the altcoin side.
That's absolutely fascinating. I'm serious alpha. I mean, this is, I've not had that lens on the market before to understand the sort of dynamics of equity, and it's super interesting to get it from the central bank monetary policy. How much do you think Bitcoin is related? I know they're very correlated to equities. Is it directly correlated? Do you think people are buying the inflation hedge thing? Do you think eventually
I think of markets as complex. It's not just I think of markets as complex systems. They are. So there is really rarely a single variable driving price. So the way to think about it actually is there's going to be, say, 20 variables, of which maybe 5 are important. And then each one has a weight, which is impossible to ascertain with any with a high degree of confidence, because it's all very subjective and it's all basically data, and you're processing the data in real time with very incomplete information. But the point there is that's just one variable out of many. On the correlation is like you say, usually the correlation is it's like say 30% on say a 20-day or 30-day rolling window, and that shoots up to basically 40 to 70% with basically the S&P, between Bitcoin and the S&P. So that happens. People are trading it, and yeah, people are trading that. And it kind of becomes like a self-fulfilling prophecy. And if you have people running algos, they start seeing these patterns, and they react and they change the inputs in their algos to basically respond to the different markets. So it truly is a self-fulfilling prophecy.
Yes, absolutely. It's I think it was like Schelling points where people basically everyone's starting to see the same idea, and then that idea becomes the reality because everyone's
exactly.
So yeah, that kind of that's super interesting around the kind of correlation between those markets. The kind of Bitcoin, right, is that because it's scarce money, it's going to have this inflation hedging dynamic to it, which implies that it will eventually decouple the equities markets. Do you think that's likely to happen? Does it feel different as an asset to trade compared to equities?
No, I think we're very, very, very far away from that happening. It's actually interesting. I think the odds of that happening are very low. I mean, in the sense that I think it is happening, but it's not happening enough to drive the market. I think a very minor set of market participants are actually that move big flows regularly are using Bitcoin as an inflation hedge. I may be wrong, and I find it actually very fascinating. The latest flows report that JP Morgan puts out every Friday on the markets. Those guys have a tendency to talk Bitcoin for the last 2 years, year and a half, and they are hit and miss. Sometimes they're spot on. I would say most of the time they're late, or they tend to be too bearish. Anyhow, they're for being sell side, they're good. And the point there was I was quite surprised to see the latest report they put out, talking precisely that they think that the main driver is actually inflation hedging, which I don't agree with, but I'm open to being actually entirely wrong. And I think we've it's not going to take too long for actually become evident if actually that's the main driver or not. So their point of view is that the main driver is inflation hedging right now.
Yeah.
My point of view, and it's not the ETF. So my point of view is that exactly the opposite. It's actually the ETF, and the other one is most like a secondary narrative. And the way I quantify this is by actually if you look at the Bitcoin trade, basically the reversal from 40 to 48 and then 51, that's a combination of basically the market getting overly bearish on late news and excuse me, French once again, bullshit like Evergrande. It's important, but not as the market portrayed it. Like, okay, this is the end of the world. No, it's just very important short-term noise, maybe even midterm noise. The point why being there is like we dropped sharply down on two key reasons. One was Evergrande, basically all of social media and media finally discovering this thing that had been going around for a very long time already, quite a few months. So they latch onto the narrative at the very end, and everybody panics. And it was a very, sorry to get into this, but because it's not really exactly the answer, but it was a very interesting divergence between the perception of Eastern money and Western money around Evergrande. The West saying this is a Lehman moment, the East saying this is going to be handled by the CCP as it has already been handled quite a few other times. And there is a roadmap of basically examples of other companies that went through similar things and what the market should expect. So the point there being is we drop on exaggerated perception around Evergrande and all news about China, because there was another set of China news that was actually massively misreported by Bloomberg, outright lies, the way they published it, and they moved the market. So we get a correction on the basically misinterpreted news, plus a technical correction. If you look at the chart, basically from 43.5 to 48, that's a technical move that one should expect when trading. And again, this is not just for traders. If you're trying to get and put some chips in your book and rebalance your portfolio, etc., you have to be aware of these things. It helps a lot to be more profitable. So between 48.5 to 48, you have a huge gap. That's basically basic technical analysis 101 or maybe 201, where you should expect very little resistance in that move. So if you're going to be selling, you wait till way further out. Like you don't, you 48.5 to 48 is the non-selling area. And then that basically becomes again a positive feedback loop. And then once you re-near 50, well, you go after 50 and you hit the stops. So the way I see it, and this is subjective, because you cannot be certain of these things, but this is my view, is that the Bitcoin futures trade starts at 51K. And from 51K onwards, what you see is the CME open interest, which historically is very low in relative terms, relative to other Bitcoin markets. It goes up by 2x since then. And what tells you that the drive that this is actually a CME ETF move, and that's the dominant narrative, is that the CME OI, the open interest, doubled in that period of time, so from 51, while the open interest, last time I checked, was actually 4 days ago, so I don't know right now, but the open interest on other markets, basically on stablecoin margin futures, remain rather flat, and the open interest on coin margin futures was up only 20%. So 20%, 0%, yet the CME, on the other hand, 2x. And one last thing on this topic is, and this is, it's incredible how it happens over and over again. There's a pattern here, but the point is, open interest is reported usually, I mean, shown, visually shown in dollar terms, and you need to adjust by basically the price of Bitcoin to basically to have the actual increase in open interest. So If you're just basically making a trading decision of basically selling because of the open interest is going up too much, you're literally making a decision on a variable based on the same variable. Because most of the open interest variable time series is going to have two inputs. One is open interest itself, the number, and the other one is the Bitcoin price. And the Bitcoin price is going to be most of that time series. So it's kind of like making a decision about price exclusively based on price.
Mm-hmm.
And for that, just ignore open interest.
Yeah, so
and,
typically give you an insight into how much leverage is,
that's exactly what open interest is for.
Yeah. So there are these moments when there's lots of leverage, and particularly on on these big moves, and leverage builds up. There's lots of traders on 120 sort of degen leverage on Binance. Is there
like right now?
Is that kind of a moment right now? So what happened today? So there was this kind of big sell-off moment today. I was just watching as we were about to sort of comfortably sail through all-time highs on Ether. And then there was a kind of big sell-off.
But it's not really comfortable at all. The interest rates are going absolutely ballistic. And under normal circumstances, I'd be selling very aggressively in a point like that, and I think everybody should be doing the same. This was special in my view because it was a break on through all-time highs, basically, on the back of very bullish news that one should expect should continue for the next month, like all these ETFs being approved. We have the Valkyrie ETF that's coming into the market, another big one tomorrow. So kind of like the point there being is that it's extremely hot, the market, but it's justified. It's justified for it to be that hot. If you look at the funding and implied interest rates in crypto markets back in basically December 2020 and the 20K breakout, you're gonna see the exact same thing. Actually, it was even hotter. It got even more hot than last night. So you get to a point where basically, like if you get out of the train to basically save on a 5%, you may lose a 15% ahead, and then it becomes very hard psychologically for many people to jump back on board. But that being said, back to the point of today, it was leverage, not what the narrative is, which is basically some algo gone bad and making Binance US crash, and therefore the whole market's crashed. No, it's just leverage. And that Binance US thing is just because they have no liquidity.
Yes, just really thin books. And I mean, there was like a wick down to $8,000 or something crazy. It must be an incredibly illiquid market. So, I mean, that kind of circles us back to that point around the fractionalized liquidity, and the exchanges have far less liquidity than they normally have. And this is the thing that's been for all these years, isn't it? What's changed and what's brought these on?
That hasn't changed yet. There's just more money in the system.
So why are they approving them? I think that's the kind of what.
Why they're approving them? Because it's you mean the ETFs? Why you broke up right before briefly? Well, the thing is because that hasn't changed. That's why spot market ETFs haven't been approved.
Right.
Like when approving ETFs, basically the SEC is focusing on the following. They want to see no manipulation, or basically they want to see that perceived, which is very subjective, that the market is not manipulated, and if it is, then they want to see information sharing agreements with regulated markets, which means basically, like for example, the CME is a regulated market. They have information sharing agreements, which means the CME is giving that information, well, in this case, it's to the CFTC, but if it were securities exchanges, they are giving real-time information and a lot of information to the SEC, very granular. So that's what the SEC wants to see to approve an ETF on the spot side, which would be way more bullish than the current set.
And that's they need to buy the underlying asset, right, to back it rather than use futures contracts.
Yeah, well, at the same time, that's not the case, because if you buy a futures contract, a market maker behind you is buying spot.
Yeah.
So there's a very, very, very extreme misconception in the marketplace. It's actually incredible that so many years in, and we're still talking about the same thing, how ETFs are bad, futures ETFs are bad. No, it may be a very bad product because it suffers from what is called contango bleed. So it's therefore bad for long-term holders. Holding an ETF with futures as underlying, but it brings in flows, buying flows, net buying flows, and it is most definitely bullish. And the market makers, whenever you are buying an ETF, they have to turn around and hedge and buy the futures. In this case is not the market maker. In this case is the ETF itself. The market makers do something else.
So the further ETFs that are coming down the line, are they more of the same? More futures like ETFs? Are we close to a spot ETF anytime soon?
My view is 1 to 2 years. Some very, very smart market participants, I think, is going to be much sooner. I think it's 1 to 2 years. And I think the way I see it is the following. So what the SEC wants to see is most flow taking place in regulated markets with information sharing agreements. Well, this is exactly what this set of ETFs with futures as underlying are doing. They're bringing massive volume into the CME. So if the CME becomes the dominant market, combined with other markets in the US, then the weight of non-US markets and unregulated markets diminishes dramatically. And if it diminishes enough, then the SEC is going to be ready to approve a spot-based ETF. So it's kind of like one step in the right direction, and it not just one step. It's like it actually actively helps to get to the next step.
So is the outcome of this then that we end up with far less volatile Bitcoin market?
No, not at all, because this actually it's very interesting. The fund, the ETF, has to basically buy futures, and also they have limits to the number of futures they can buy on each contract. So they have to buy futures along the curve. So what they're doing is they're pushing the curve, the futures curve, up, because when you're buying something, you just push the price up. By doing that, you're increasing what is called the increasing contango. You're increasing the slope of the time structure of the futures market. And by doing that, you're increasing the implied interest rates. What that means, basically, think about it the following way: if you buy a future at 5,000, and if you have a futures contract at 5,000, and you have a spot contract at 4,000, so there's a $1,000 premium. So basically, if you buy spot and short the futures contract, these two assets will converge perfectly at whatever value, but perfectly at the time of expiry of the contract. So if the spread is 1,000 and you're short the asset that is higher, the futures that has a higher price, you're gonna make a 1,000 profit by expiry by holding this spread. That 1,000, if you basically take it into account the capital you put and you annualize it, it gives you an implied annualized interest rate that you can capture as a trader. So what this thing does is gonna bring massive amounts of institutional capital to arbitrage this away and basically try to push the curve down and profit in the process. Higher interest rates tend to make things more volatile, not the other way around.
Interesting. So the already volatile crypto markets could get more so, which is
for a while, until basically we overshoot and then we go the other direction. But at first, and I expect this to last for quite a while, yeah, it should be more volatile.
Crazy. And how does this reflect on kind of potential future other asset ETFs? Like, are we waiting? Are we going to be waiting years for the Ethereum ETF, or is it
Oh, I
likely?
think, I mean, I don't know the answer, but I think we're going to have one in 2022 at some point.
Yeah,
It's too early for that, but it's going to be, that's going to happen. I think at a degree, I am extremely confident we're going to see one in 2022 because the financial incentives for market participants are very high. Everybody makes money. The market wants it. There's already a precedent. Let's do it.
Yeah.
Now, the next race is going to be actually setting futures contracts for other assets, like other layer ones, like Solana, etc. It's everybody's going to, like, to get those ETFs on other assets, which everybody wants to do. You first need futures contracts. So you're going to have all these asset managers and people who are companies looking to launch funds are going to be basically talking actively with the CME and the CVO and the CME to get futures contracts on various assets.
Interesting. And how do you think the kind of decentralized exchanges play into this? And is Uniswap? There was a point where Uniswap was the dominant volume in the exchange market in the crypto space. Is they influencing the markets, and will they influence the ETFs and futures trading there?
No, I don't think so. I think they're of secondary importance. What is very important is basically derivatives exchanges, because there's all this. By the way, leverage on the CME that you can get is very, very low. So you have low leverage on the CME, and you have non-US exchanges cutting down on leverage from 100x to 20x to even lower aggressively. But there is demand for leverage, and you can actually set those products up in decentralized derivatives markets. So this is a mid-term trend that basically we saw this happening early, like February this year is when the theme started, and starting catching fire about 2 months ago. And now it's basically, we're like basically about to start the second stage of this trade, but it's not a short-term thing.
Yeah.
And should expect to see very large volumes flowing towards derivatives dexes. And that brings about significant appreciation of the tokens of the protocols involved.
Yeah, and these are the ones that are, it makes sense then that these are the things that seem the more immediate regulatory target. It doesn't sound like this is a thing that the regulators will want to see then, these decentralized derivative platforms.
Absolutely, but at the same time, it's there is not much they can do. And what U.S. teams can do is basically, because these are U.S. regulators, what U.S. teams can do is basically either leave the country or pretty much do what they already started doing, which is basically turn off their front end.
Yeah.
But what is on the back end, the smart contract, hey, that's app, and there's nothing I can do about it unless they go after Amazon and shut down the servers in the cloud. That's it. That's there.
Literally unstoppable.
And another thing, sorry to interrupt, is eventually there's a very clear pattern that you can observe this for for a very long time, actually decades. It's if you study the fines that the SEC imposes on companies that flaunt securities regulations are ridiculously low.
Yeah.
So
I think the EOS one was 0.6% of the raise, something like that.
There you go.
Yeah. So we can imagine a trend of where the DeFi space gets more interested is in this derivative market, in people doing what does happen in the traditional markets, but in a decentralized way, where you get greater leverage than you would do in a regulated exchange.
Yeah, and it's going to get very noisy at the same time.
Yeah.
Now, one thing on the Ethereum, on the large Ethereum DeFi protocols, they are suffering, and they're suffering for a good reason. Is basically liquidity starting to flow to other chains, and we're going towards this multi-coin world, the narrative that is becoming reality. Again, this is something that a year ago it was heresy, but now it's starting to be accepted as the new status quo where we're going towards.
And I get the sense there's this phenomenon where it's like there's things that happen on when the new chain opens, Binance and Binance Smart Chain, saw it Polygon, saw it with Arbitrum a little bit recently. There's almost like again, and I guess that's dragging liquidity out of Ethereum to these new chains. Does it stay there? Have you noticed this? Does it stick?
No, it's the hot ball of money. It moves around aggressively.
Yeah.
But before it was in Ethereum. Now it's moving around aggressively all over the place. There is some of it is sticky, but much of it moves aggressively.
So presumably watching the bridges is a good thing to do between.
Yeah, but the thing for those looking for a trade, the bridges right now are really hot.
Yeah.
So it's the kind of thing you get into on a market correction. But again, they always happen 4 to 6 weeks. You're gonna have that 40% drop on outs.
Yeah, so you mentioned earlier that there was kind of ways when you see these predictable sort of market washouts and bounces, particularly on the kind of Sunday dry. You mentioned that alts were the way to play the kind of slightly higher risk too. How do alts fit into your strategy? Do you play alts much, or do you stick to the majors?
I'm mostly a portfolio manager these days, so I handle an exposure between X percentage and X percentage. That is always long, and in that part it's mostly rebalancing among assets, and the remainder is things that go on top, sometimes under levered, sometimes levered up to a small amount. I try to I do a lot of alts because that's where the money is, and that's where if you have a knowledge of the market, that's where the money is in the sense that this is a growth market. It's a growth market that goes up.
Yeah.
So you want to be in the faster horses for as long as they have liquidity, or you have good information that allows you to be early, or you have good timing. But ideally, you want to be in the faster horses. And Bitcoin is fantastic, and I'm very grateful, and I love it, and etc. But Bitcoin is slow. Why is it slow? The way to think about it is Bitcoin is a massive rock. Ethereum is a mid-sized rock. And then you have a Phantom, which is a smaller rock. And then you have a Arweave that is a pebble, right? Yeah. So depending on the size, is plain physics. Depending on the size of the mass, you need more force to move it. Yeah. So you need much less force to move a layer one that is not Ethereum. That means that when the equal like X amount of capital pushes it, it's going to move way faster, way more. And if you're talking about a structural bull market where things just go up by getting into alts, you're going to enjoy or you're going to realize much higher rates of return that you can in just Ethereum or even worse, Bitcoin.
Yeah. And so it's funny, I think of it the same sort of physics like way. It's like when you kind of got a skipping rope, right? Where there's like the alts move on big because they're kind of like closer to the kind of amplitude of it. But I mean, how do you understand the alt market? How do you start to build a portfolio by looking at it when you can consider that like literal dog money is the thing that moves the most in the market at the moment? Like, how do you build a portfolio in that environment?
Well, you divide it into categories, and you decide what categories you want to be in.
Yeah.
So dog money is a category. You have exchanges is a category. DeFi is a category. Layer ones is a category. NFT platforms is a category. NFT pieces is a category. Bitcoin is a category, and Ethereum is a category. You just split it up in categories. Decide what weights you want to have in each category. Then afterwards, you choose the main winners in each category that you want to have exposure to. And then you allocate a little bit right away. Usually that's the best approach. And with the remainder, you just wait for the pullback, the flash.
Yeah.
That's the approach. And dog money, it's yeah, dog money is a category, and it is what it is. At the end, is much of the things we're trading is just memes. It's like the ultimate thing of like showing that most of these things were really actually trading narratives.
Yeah.
There is large funds, smart money trading dog money. Now they're getting incredibly to incredibly, but they are. So it's kind of like we have to accept it into basically coins that used to be considered scams, like hex.
Yeah.
Eventually, everything that stays that has enough staying power and stays long enough, if it manages to develop a healthy community, the odds are that coin is going to survive and have staying power.
Yeah, I've noticed like Three Arrows talking about SHIB and Doge, and it started with Doge, but real large funds talking about trading meme currencies. And I suppose this has happened in the traditional markets too, with the whole GameStop and AMC stocks. Is this a trend? Are we moving into a kind of based? Is it
It's
going into
definitely
the equity?
it's a combination yeah, it's a trend. I mean, first of all, you need like the seed for this to happen, and the seed is actually massive amounts of liquidity and everybody having extra cash. So then money starts pouring into these meme things, and once enough money pours in and stays in for an X period of time, that then becomes an asset with basically that reaches escape velocity or a theme. So I think it's going to continue for as long as we don't enter with like liquidity conditions don't change in the marketplace dramatically, and we enter into a different paradigm. I think we just need to accept them. It's like NFTs.
Yeah,
Like, okay, it's like, or like baseball cards. You think baseball cards are worthless? Well, too bad. There is millions of people that think they're worth a fortune. It's your bad, your problem that you don't understand. It's the same thing with NFTs and the same thing with meme coins.
yeah. I mean, I admit to finding it very difficult to accept the dog money thing, and then we've kind of got a secret dog money project we've been working on in the past, as you know, and I'd sort of come round to it, and we've had a conversation about this before. You kind of just have to accept what the market is. It's that, do you want to be, you just need to accept that the market does things that you don't at times.
Exactly. People likes dog coins. We have to respect it.
Yeah.
Even better if we can actually help them and profit as well. But at least we have to respect it. And there's a difference between dog coins, pure meme coins, and the likes of XRP, for example, is that they don't sell you a false narrative. There's no bullshit. It's like we're just a meme, or we're just a DAO, and we have this burning mechanism. This is what we are, and we're transparent. XRP is the kind of coin that basically they try to sell you a piece of nothing, like an orange for a steak.
Yeah, the future of banking.
It's a false narrative there.
Yeah, it is. So the kind of more honest, the more legitimate the memes. I mean, this is the case with NFTs, right? They're just JPEG. There's no pretense or fundamentals behind many of them. So, yeah, what have you done? I've noticed you've got an NFT there at the moment. Like, have you done much in the NFT market? Do you see it as something that's going to stick around? Do you try and get exposed to it?
I think is I do NFTs. I don't do enough. I don't do enough because I don't have time. But I do, I think, quite a bit. Takes away from my sleep. It is profitable. I think it's something that belongs in a crypto book, in a portfolio, and I definitely think there is a bubble right now on the NFT on prices. I think the way to think about this is like NFTs maybe like Bitcoin 2013 right now. So for NFTs, this is Bitcoin December 2013. Well, you know what followed? Eventually a big crash, and eventually we continue higher. And NFTs, I firmly believe that they're going to end up, there's a high likelihood that they will end up onboarding more people into crypto than Bitcoin itself. Because if you think about it, how many people care about sound money and inflation hedges? Most of the people don't even understand those terms. There's no finance education until you reach college, and maybe then if you choose the right path. But everybody understands art and visual and like pretty things, and you may hate these things that can be copy pasted, but they can be copy pasted, but they can't. Yeah, Mona Lisa can also be replicated with a high degree of precision. And hey, it's digital. I can store it and I can transfer it whenever I want. It's like a card. And then you have basically copyrights, tickets. There's so many things that should be taking NFT form. And it's just easy for people to understand and entertaining.
Yeah, I couldn't agree more. I mean, I'm talking to a football club tomorrow about NFTs. That there's going to be huge audiences, just influencers. There's millions of followers who are going to issue NFTs, and that's what drives that adoption curve. And yeah, I mean, it's almost impossible to not be bullish on the crypto market at the moment. So yeah, I mean, Alex, that was absolutely amazing. So much information to take in. I'm hoping we've recorded that. I think people are going to be picking apart that bits of information. I think we've got a few minutes left. If anyone's got a question they'd like to ask, stick your hand up, and Chris might be able to do it. I don't know if anyone on the Matt, anything you want to ask, or if anyone wants to propose a question to Alex for the last few minutes. I'm not seeing any hands. Oh, then we've got Dom here. Let's see if we can get Dom. And yes, I've sent you an invite, Dom. You should just need to confirm it. And here he is. Hi, Dom.
Hi, Dom.
Can you hear me? Yeah, hi guys. Just a question for Alex. Obviously, we're all bullish on DAOs and NFTs. I'd just like to hear from Alex what you saw in FET that made you kind of come on board the project.
Mainly two things. I think the team is fantastic, and that's really important. And secondly, the fact that I think DAOs are it's a high probability play into the mid to long run that DAOs take off, and FPT can be a great what I would define as an infrastructure play on DAOs. So I think it has a lot of potential. It's a matter of realizing it and getting the word out there and doing marketing. Marketing is expensive, takes time. Communities need to be built. These things take time, but I'm very bullish, and I think they're on the right track, and I like them.
Awesome. Yeah, great answer. Thank you.
Yeah, thanks for asking what I couldn't do. That was very nice of you. Great. Maybe squeeze one more question. Click your little hands up button, or if there's anyone else.
I have a question if nobody else has a question, but I'm happy to wait to see. Oh, Max Cam has a question.
Let's get Max on, and we'll finish bang on 9. Max.
Just a quick question on where, Alex, you mentioned on the alts, the different sizes comparing Bitcoin and the other ones to move the market. What do you think is a good size that has a good chance of movement during a bull run, such as the one hopefully that we're seeing?
You mean like to move the market, like size-wise, like amount of dollars? It really depends coin by coin, really. I mean, you take let's make an like extreme example. With Bitcoin, you can put a $10 million order and you won't move the market. You put a $10 million order in Solana, you're gonna see some movement. You put a $10 million order in Perp, it's gonna pump. And you put 10 million into microcaps, and you send it multiple X's to the stratosphere. It really depends. Is asset by asset.
Thank you.
And do you trade anything on DEX, Alex? Do you go to Uniswap and get into the shitcoin dungeons? Stay on the exchange?
Yeah. Yes, I do. Yeah.
Good man. Matt, you had a final question? Do you want to jump in on that?
Sure. It's kind of something related to Alex spoke about at the beginning of the interview about interest rates at the zero bound. I think I'd like to understand your opinion on the bond market as a sort of predictive tool for understanding the, I suppose, whether where we're going inflation wise, because it seems to me everyone talks about the bond market, but actually the bond market seems to be really bad at actually predicting what's going to happen with regards to inflation, deflation, or anything else. I don't know if you have an opinion on that.
Well, that's because basically the bond market reflects the prediction of people, and people are generally bad at predicting things in the short term. But if you look at the long term, actually, they're very good at predicting things in the long term, or more like it's the long term becomes unavoidable. There is a very strong trend down in the prices of bonds, extremely strong, that lasts for 2 decades. And you're going to see basically interest rates trending in the exact same way across the curve, and you're going to see inflation doing exactly the opposite. So the bond market in the long run reflects the interest rates implied in bond prices reflect inflation very well. Right now, the bond market is most definitely getting worried about inflation. Now, the thing is, there is this consensus in the marketplace, with which I agree, that inflation is transitory in the sense that it should be starting to basically wash away by in 6 to 8 months. There's a misconception there that basically the thinking that what is inflation? Inflation is a change, a rate of change. So we're not going back to prior prices. The point is inflation going back towards 1 to 2% levels, not about retracing price increases. So the joke in the marketplace is that, hey, this inflation is transitory. Is not. Look at all these price increases, and yeah, that's just high inflation in the short term. I think the market is most definitely getting worried about inflation. You've seen it. Inflation and more than inflation is actually reacting mostly to the Fed and the dots and the last FOMC. They raised the dot plot, which is the projections of Fed members, very aggressively. So the bond market started reacting to that. Now, the beauty is that correlations between bonds and the equity and crypto, they're not steady. So, for example, you take the bond market in April, and in April, the bond market was actually the main variable for about 2 to 3 weeks behind Bitcoin. Right now, it doesn't matter. It affects basically the rates on the long end. It's going to change the trend on tech stocks heavily, because tech stocks, basically most of the value of tech is derived from basically the terminal value that you have to discount with a low interest rate. The point being, I think, is back to your question, is I think actually the market is reflecting, is concerned about inflation. And I think the trend is going to reverse.
So, if you don't mind, I'll ask a follow-up question. So, you think it's transitory inflation, and some of the other economic commentators are sort of talking it could be something closer to 1970s type inflation, 1930s type inflation, or sort of an Argentinian style inflation. What would have to shift in the market for your view to change?
The Fed has to lose control of the marketplace. You need to see basically the Fed saying one thing and the marketplace doing another thing. When the Fed loses control of the marketplace, means the marketplace is not trusting the Fed anymore, which quite likely means that what's happening is what is called an anchoring of inflation expectations. Because at the end, inflation comes down. It's like a self-fulfilling prophecy. Once again, I use this term all the time, and I go by it, and it applies to most things in life we do. Is if we believe that inflation is going to be under control, then we market participants, or people, not we, like people that actually have businesses, they're not going to be raising prices, and labor unions and laborers are not going to be requesting wage increases. So if the marketplace trusts the message of the Fed that inflation is transitory, the odds of inflation being transitory are very high, because the marketplace is not going to be pushing for wage increases and price increases. If at any point in time, and this is not any point in time, this is like it's a spectrum. You move slowly across the spectrum, right? But if at any point in time, to use the language I was using before, the marketplace stops trusting the Fed, then you go on the road of basically inflation expectations getting out of control. And the moment that happens, then we're fucked. And that is when you get a mini Argentina. By the way, I'm Argentinian.
Right, okay, I didn't realize. Okay.
Did you see that firsthand then, Alex?
Yeah. I was an economist working for the government back then.
Wow.
I was working with the Secretary of Economic Development, who was the right hand of the Minister of Economics. I was like right under him.
Fantastic. That's incredible. I'd love to get into that deeper, but we are over time now. So I want to let you run off, and thanks so much for coming along. Let's do this again at some point.
Okay, thank you so much for having me. I hope to everyone out there, I hope you enjoyed this, and hopefully gathered something useful. And again, thank you for having me.